Have you ever wondered how traders can make money when the market is not moving much? Today, let's understand a simple option strategy called the Iron Condor. Don't worry if you are new to options trading. I'll explain it in very simple language. An Iron Condor is a strategy used when a trader expects the market to stay within a certain range. For example, imagine Nifty is trading around 25,000. You believe Nifty will not make a big move. You think it may stay somewhere between 24,500 and 25,500. In this situation, an Iron Condor can be considered. The interesting thing about an Iron Condor is that it uses 4 option positions together. It may sound complicated, but the basic idea is actually simple. We are creating a range. Inside this range, we want the market to stay. If the market stays inside our expected range until expiry, we can potentially make a profit. Let's understand the 4 positions with a simple example. Suppose Nifty is at 25,000. First, we sell a 24,500 put. Then we buy a 24,300 put. On the other side, we sell a 25,500 call. And finally, we buy a 25,700 call. So, we have 4 option positions. 2 put options and 2 call options. The options we sell are closer to the current market price. The options we buy are further away. The options we buy are mainly there to limit our risk. Now imagine that Nifty stays between 24,500 and 25,500 until expiry. In this situation, the options we sold can expire worthless. The premium we collected from selling the options becomes our potential profit, after considering the premium we paid for the protection. This is the basic idea behind an Iron Condor. We are not predicting whether the market will go up or down. Instead, we are predicting that the market will not move too far in either direction. That is the key idea. Now let's understand the profit and loss. The maximum profit of an Iron Condor is limited. It is generally the net premium collected when the strategy is created. The maximum loss is also limited because we have bought protective options. This is one of the biggest advantages of the Iron Condor. You know your maximum possible loss before entering the trade. But remember, limited risk does not mean no risk. If the market makes a strong move and goes beyond one of the important strike prices, the strategy can start moving into a loss. For example, suppose Nifty suddenly moves strongly above 25,500. The call side of the Iron Condor can start losing money. If Nifty falls strongly below 24,500, the put side can start losing money. The further the market moves outside our expected range, the more pressure the strategy faces. So, when is an Iron Condor generally considered? It is usually considered when the trader expects low volatility or expects the market to remain within a range. For example, if the market has been moving sideways for some time and you believe it may continue to stay in a range, an Iron Condor may be one strategy to study. But there is an important point. The market does not have to stay exactly in the middle of the range. The strategy can still be profitable as long as the market remains within the profitable zone at expiry, depending on the exact strike prices and premiums. This is why understanding the break-even points is very important. The break-even points tell you where the strategy starts moving from profit into loss. Another important factor is time. Iron Condors are generally designed around option expiration. As time passes, the value of options can decrease, especially when the market stays quiet. This time decay can work in favor of an option seller. But again, there is no guaranteed profit. A sudden market move can change the situation very quickly. News events, major economic announcements, unexpected market movements, and changes in volatility can all affect the trade. So, beginners should not enter an Iron Condor simply because someone says it is a safe strategy. It is not a risk-free strategy. Before using real money, you should understand the 4 positions: the maximum profit, the maximum loss, and the break-even points. It is also important to calculate the required margin and understand how your broker handles the position. The easiest way to remember an Iron Condor is this. You are creating a range. You want the market to stay inside that range. You sell options closer to the expected range boundaries and buy options further away to limit the risk. If the market stays within the expected zone, the strategy can make a profit. If the market makes a strong move outside the range, the strategy can lose money. So, Iron Condor is mainly a range-bound option strategy. It is not about predicting the exact direction of the market. It is about predicting the possible range of the market. And that is what makes the Iron Condor interesting for options traders. But remember, this video is for educational purposes only.